Welcome to this explainer. Today, we're diving into an exclusive, verified research report from May 2026, and we're unpacking a financial engine that has quietly but completely taken over the world. I'm talking about a global market that just hit a staggering $19.85 trillion. Whether you're totally new to finance or a seasoned market watcher, you've got to understand how this massive pool of capital is moving, because it is literally reshaping economies around the globe. Okay, let's dive into this. Here's our roadmap for today. We'll quickly cover what ETFs actually are, the global explosion, the hidden engine behind them, the massive boom happening in Brazil, the real risks involved, and finally, some strategic insights. Section 1. What are ETFs? The foundation of the market. You probably know the basics, but an ETF, or exchange-traded fund, is essentially an open-ended investment fund with a superpower. It trades on a stock exchange all day long, exactly like a regular stock. When you buy a share, you're getting a slice of a whole basket of underlying assets: stocks, bonds, commodities, you name it. But the game really changed back in 2019 when the SEC adopted Rule 6c11. That created a unified, transparent legal framework, wiped out decades of red tape, and perfectly set the stage for what happened next. Section 2. The global explosion, a multi-trillion-dollar market. By the end of December 2025, the global ETF market reached an all-time record, $19.85 trillion. To put that breakneck speed into perspective, that's a massive 33.7% growth jump from just the previous year. We're talking about over 15,000 different products spread across 83 exchanges worldwide. Now, what's really interesting about this breakdown is the sheer concentration of power. Almost 60% of this nearly $20 trillion pie is controlled by just three heavyweights. BlackRock's iShares leads the pack with 28.1%, Vanguard is right on their heels at 21.6%, and State Street holds 10.1%. When just three asset managers are steering the majority of global ETF flows, they have an undeniable influence on global markets. But hey, the traditional guys aren't the only story here. The last couple of years saw an absolute crypto explosion. Starting with the historic SEC approval of the Bitcoin spot ETF in January 2024, the dominoes fell fast. Ethereum, Solana, XRP, they all followed, and the numbers are completely mind-blowing. BlackRock's Bitcoin ETF hit $100 billion in assets in a record 435 days. For some context, the old record for an ETF reaching that milestone was over 2,000 days. It spread like wildfire. Section 3. The hidden engine, how ETFs work behind the scenes. So, the absolutely crucial point is understanding this exact mechanism, creation and redemption. This is the secret sauce. You have authorized participants, or APs, which are basically massive financial institutions that act like market bouncers. If the price of an ETF gets too high compared to its actual underlying assets, its net asset value, the AP steps in. They buy up the underlying assets, swap them with the fund for brand new ETF shares, and sell those shares to pocket a sweet, risk-free arbitrage profit. By doing this, they increase the supply of the ETF, which instantly pushes the price back down to where it belongs. It's a beautiful, self-correcting engine. And because of that incredible efficiency, ETFs are super cheap to run. Vanguard's average expense ratio sits at an ultra-low 0.04%, compared to the industry average of 0.23%. Now, that might sound like just pennies, but let's look at the compounding mathematical magic over time. If you invest $10,000 at a 7% return over 20 years, a 0.03% fee leaves you with about $38,700. If that fee is 0.5%, you're left with $36,200. You literally lose over $2,500 simply to management fees. That right there is why this structure is so revolutionary for the everyday investor. Section 4. The Brazil boom. Accelerated growth at B3. And this brilliantly illustrates the crazy local momentum we're seeing on the B3 exchange. In just one single year, the Brazilian ETF market exploded from 54 billion reals in 2024 to 91 billion reals by the end of 2025. I mean, that is a 68.5% jump. We are now looking at over 919,000 investors actively using these instruments in Brazil. But what was actually driving that massive local surge? Surprisingly, it wasn't flashy tech stocks. Over 60% of all new inflows into the Brazilian ETF market in 2025 came straight from fixed income ETFs. Investors flocked to products linked to the Selic rate, using the ETF wrapper to get highly efficient, liquid access to domestic government bonds. Section 5. Real risks. What could go wrong? Look, to be completely objective, every single financial product carries documented risks. With ETFs, you've got your standard tracking error, where the fund slightly misses the exact return of its index because of fees or cash drag. You have liquidity risks and currency risks if you're buying international assets. But the most fascinating risk here is systemic, single AP dependency. Remember those authorized participants keeping prices fair? Well, academic research from the 2020 Dash for Cash event showed that during extreme market stress, if a primary AP gets capital constrained and steps away, the ETF's arbitrage mechanism can temporarily break down. The price completely detaches from its true value. It's rare, for sure, but it's a structural vulnerability we have to be aware of. Section 6. Strategic Insights, Future Projections and Scenarios. Let's move to and see how this builds into our future outlook. Where does this gigantic industry go from here? What are the verified market projections telling us about the landscape leading up to 2030? The biggest strategic trend right now is the massive shift toward active ETFs. These grew by 55% in 2025 alone. Investors basically want active management, but they want it inside the cheap, tax-efficient ETF wrapper. As a result, we're going to see continuous fee compression across the board. Down in Brazil, the regulator, CVM, is explicitly targeting 2027 to roll out their official framework for these active ETFs. And globally, major institutions are projecting this market will hit an unbelievable $35 trillion by 2030. And speaking of the Brazilian scenario specifically, local market estimates suggest the potential to hit R$500 billion, $500 billion, in just the next 3 to 4 years, with a long-term sightline on R$1 trillion. Now keep in mind, these are just market estimates and projections, but the trajectory of adoption is undeniably steep. Now, before we wrap up, it's absolutely crucial to state that this explainer is strictly for educational and informational purposes. We've compiled data from verified external projections and third-party sources without any ideological bias whatsoever. This absolutely does not constitute investment or financial advice of any kind. Markets shift, and past performance is never a guarantee of future results. If you found this breakdown valuable, you definitely need to subscribe to the Macroeconomy IA channel. We constantly explore the fascinating intersections of macroeconomics, artificial intelligence, and technology to bring you the sharpest insights. Click the links provided to learn more, follow the channel, and make sure to stay tuned for new publications. Because as we look toward 2030, the question isn't whether ETFs will dominate the market, but rather, will your portfolio be riding the wave or swept away by it? Keep learning, stay focused, and I'll see you next time.